For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Hey, welcome back to the show. Managing Your Financial Future, yet another episode of this particular podcast. I'm your podcast host, Johnny Dean, here with, I'm going to say it right at the start of the show, Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor.
Woohoo! Way to go, John.
Once again, I'm doing that without the cheat sheet, so I feel pretty good about myself. And I think this is going to wind up being a pretty good episode as a result. Right?
Oh, okay. We're starting off strong.
We have started off strong. And speaking of starting off strong, we could start off strong and completely tail off, you know.
We
could have some good minutes in the beginning and some bad minutes at the end.
Well, it happens. But sometimes you have really bad minutes beginning, but finish strong.
Exactly.
On average, we're doing fine.
On average, we're doing fine. Now, you're wondering why we're saying this kind of stuff. This is a precursor to what we're going to be talking about here. I feel really good about this, Professor Plum. All right.
And I caught on to your lead. I followed it.
I know. It's really something. I'm very impressed with you. You're starting to become media savvy, after all these years. All right. So what are we talking about? Well, last week's show, and I'm glad we're doing this week. Last week, Professor Plum, we took a hypothetical couple and we bucketized them. You came up with some assumptions about this married couple. One was age 67, one was age 65. They needed
$96,000 a year.
$96,000 per year of income. They had some Social Security. Anyway.
Some now, some starting in 3 years.
Yes. And so what wound up happening was we were taking a certain amount out of the portfolio, but you bucketized them.
Yes.
You separated. They had $1 million just to make the math easy. And we separated them. You took $300,000 and put it into bucket 1 for them, and that gave them income for the first 7 years. You took another $250,000 and put it into bucket 2, which gave them income for the following 8 years.
I'm going to change one word you're dealing with.
Okay. Oh, cash flow.
Not income.
You're right.
Cash flow.
I try to catch myself when I do that. And there is a difference there. Let's say cash flow. You're correct. So it gives them another 8 years of cash flow, right?
Desired cash flow. Yes.
Right. So that gives them you bought them 15 years of cash flow. Helps them pay their bills. They can get whatever they want to do with it. It doesn't matter. That's how much they needed. And so you left another $550,000. Oh, $450,000.
We used $550,000 for bucket 1 too.
Thank you. It's been a week. Okay, $450,000 in a bucket 3 to grow over 15 years, and you're going to let that go untouched. And after 15 years, that $450,000, you assumed an 8% average overall rate of return.
Stock market.
And what you wound up with was about $1.4 million somewhere in there. So after 15 years, they had their $450,000 turned into $1.4 million, and now they're 82 and 80 years old. They've got $1.4 million, and they can take and rebucketize that. Okay, that's how we did that. I hope you heard the show. It was really good. We're going to have to try to top it this week.
Piece of cake.
So we explained why we did this, Professor Plum.
Well, and you teased the reason why. The traditional systematic withdrawal from a balanced portfolio can work at times. And unfortunately, though, it doesn't work all the time. And it doesn't work at the time you really need it to work, the bad times of life. And so why doesn't the traditional balanced systematic portfolio, rebalancing it, just taking a systematic withdrawal work? Because the world doesn't work on averages. We started off the show talking about starting strong, ending poorly, but on average it was a good show. Starting poorly, ending strong, on average it was a good show. Average doesn't work when you are doing things in the middle, when you are either adding money to the portfolio, or in this case, unfortunately for somebody who's retired, taking money out of the portfolio. And that's the key issue. Average doesn't work. Not all returns are created equal, depending upon how you use that investment.
Yes. When you're adding money to a portfolio, the averages will skew upward generally. if you're doing it on a systematic basis, like when you're putting money in your 401k.
Because of volatility.
Right, exactly. And that's why. But when you're
And that's why volatility is not risk. We said that last week.
How does this all work together? This is really turning out great so far. Okay, but when you do the other way, when you're taking money out of a portfolio and you're doing what's called reverse dollar cost averaging, those averages skew downward.
Right, because you are not you're selling things when the market's down, and that money that you sold off to create the cash flow that you wanted to spend, it can never recover because it's no longer there.
And so now we're going to talk this week as a follow-up about what is wrong with doing it I don't want to call it the traditional way.
Well, the traditional way is the way it has been done for decades. It's very easy, especially with computers nowadays. It's a lot easier just to set it and forget it. You can have computers automatically rebalance you. You just use a single, target date fund or a balanced portfolio by itself and use a systematic withdrawal. You can just say, hey, send me my X amount of dollars per month, and I'm not going to worry about it because somebody else is doing it. And it doesn't take any oversight. It doesn't take any management really, other than what the computer's doing for you. But does that mean that it's the best thing for you? And I would say probably not.
No.
Now, if all we have are good, average to better than expected year-by-year returns, if we expect a 4%, 5%, 6%, and we get that every year or better, we never have a down year, then that system will work very, very well. Unfortunately, that system I just described has never happened. I'm not saying it can't, but it has never happened.
And you're really rolling the dice if you think it's going to. The whole 4% rule it came about, I think, 30 whatever years ago. And what they came up with was that you have, I think they said about a 92%, 93% rate of a chance that your portfolio will last 30 years if you do it this way.
If you start with, I think it was 4.5 actually, but and inflation adjusted, every year.
Yes. Now 92%. But what that also means is you have about an 8% chance of failure. Now I heard this brought up, and you did too.
And I was just going to bring it up. I love this.
Our good friend Danielle Accardi, who is an advisor in Boston, and she had said, would you get on an airplane if they said you got an 8% chance that we're not going to make it?
We've got a great safety record. We're 92% safety record, but 8% of the time, all is lost.
No, you would not have a single person do this. And so, yes, that is a perfect analogy. Why would you take a chance and say, well, 8% of the time, this thing isn't going to work and you're going to run out of money? So let's talk.
Danielle's not in Boston. She's Western. So there's more to Massachusetts than just Boston.
Well, that's right. Now, I think aren't there offices in Boston?
No.
Okay. Well, forgive me. I apologize. They're in the area.
A beautiful office.
That's true.
Oh, the area is beautiful. I mean, it's just a beautiful area.
Okay. So to stay on track here, the analogy is really is perfect. Now, let's talk today about the other side of this. Let's use this same couple that needed this amount of money, and let's see what happens, Professor Plum, in a hypothetical situation where things don't go quite as planned.
Or they go as expected, which is no plan. I mean, it's just random returns. But we have to be consistent in how we deal with this. Now, the Buckets strategy guide that we talked about last week has a good example, maybe a great example, of this idea that I titled All Returns Are Not Equal. And so it shows a 15-year time horizon with a hypothetical return where in one situation, one scenario, the returns are very good in the first 5-6 years and then poor in the last 5 years. And then all we did was take those exact returns and flip them. So the return for year 1 is now the return for year 15. 14, 2, 13, 3.
Yes, let me give you the actual numbers then, just so people can understand this without looking at it. If you go to the Bucket Strategy Guide, you'll see it on page 7.
Yep.
All right, but so we're taking a 15-year period of time here. All right. Now we're using these hypothetical returns, but let's say year 1 you returns 8%. Year 2 the markets go 11% positive. Year 3 18%. Year 4 14%. Year 5 12%. Okay. And then,
so the pretty good returns. I mean, that is better than expected.
But the last 3 or 4, let's say the last 5, though, Year 11 was -4. Year 12 -8. Year 13 -15. Year 14 was -6, and year 15 -5. That's a very, very bad 5 years. All right. Now what we did was we took all these returns and averaged them up. There were 15. I'd only mentioned 10, but there were 15 of them, and those averaged to be 4% when you add them all up and divide by 15. That's how you got this average of 4%. Now what they did, Professor Plum, is okay. Let's flip them around. Let's take those bad 5 years, -5, -6, down 15, down 8, and down 4, and let's make that year 1 through 5.
Right. So all we did was reverse the return order.
Exact same. We just did it in reverse order. Right. So, of course, when you add them up and divide by 15, it comes out again to 4%.
And more importantly, if I started with X amount of dollars, let's just use our proverbial $1 million. I started with $1 million. In the first scenario, where I had the really good returns and then not good, I ended up with $1,794,000. And then in the second scenario, where I started off poorly but finished strong, I ended up with $1,794,000. Same return overall, because the average actually worked, because we weren't adding money to it and we weren't taking money out of it. It was a buy and hold long-term average, and we were using the time period as a long-term time period. So it's the same return. But a funny thing happened on the way to the bank.
Which was that you decided you needed some money to live on, to pay your bills. So you're retired. You needed to take money out of it. So Professor Plum, please, let's go through this scenario. Let's say they just took this $1 million and did a 60-40 stock bond, the old traditional way to do it.
And it made those returns.
Yes, and it made those returns. Tell me what happens when you have good, let's start with the good. Let's say the first 5 years were really good in this made-up example.
Well, if we use the same two scenarios, and let's say we were taking $50,000 a year out, we're not inflation indexing, we're taking a 5% return. Well, and the one where we had good returns, well, we're earning an average of 4 over that period of time, and we're taking 5% out, but we got better than expected in the early years. Well, we ended up with a little over $1 million.
After 15 years,
we still had our $1 million plus another $20,000.
So you were able to take every year out of this $1 million portfolio in this scenario. You were able to take out, you said 50. In this case, $50,000 a year, and you were had a really pretty good first 5 years, and some lousy years 11 through 15, really bad. But overall, after 15 years, even taking $50,000 a year out of this $1 million, you still wound up after 15 years with what, $1 million?
$1,020,000.
So basically, your $1 million is still there.
Right.
All right.
That worked.
It did. You had a good sequence of returns.
The first 10 years had a series of positive returns. The negative returns weren't until the end.
Right. Okay. So now
reverse the sequence.
You have the first 5 years being really, really bad.
Yeah, and the ending value, instead of being $1 million, if I'm taking 5% of the original value out, in this scenario, it was only $320,000. Now you can find this on page 8 of your guide if you were to look at it, but it's there. But $320,000, and I would suggest that your ending result would be actually maybe lower, because you would have been taking money out of the market, out of the balanced portfolio. After the first couple of years where you're down, you're saying, well, forget this, I'm going to cash. And so then you go to cash about the time it turns around, and you don't even recover as much as this did.
You're introducing the
emotional aspect of it. Behavioral screws everything up.
Now, so what you're saying, one second. So what you're saying is, when the sequence bad returns were early in retirement, the first 5 years, you did not have, after 15 years, $1 million like you did when the sequence was good for the first 5 years. You wound up with $319,191, but $320,000. $320,000.
32% of what I started with.
You had almost $700,000. Actually, you had $700,000 less. You still took your $50,000 a year out for 15 years, but you had so much less.
My effective rate of return, my return to my actual person during that 15-year period of time was just over 1%. But it was a 4% average, only if you leave it alone for those 15 years. It was actually, in this scenario, with using the exact same returns, it was a 1% average.
So, you know what, in this example, so Professor Plum, if I'm this couple, this hypothetical couple, and I retire, and I know that I don't know what my returns are going to be, but I know that I'm taking money out in this systematic withdrawal method, and I'm seeing this example. You know what? I am going to be very, very concerned year after year after year that the markets are going to be bad and I will have no money left.
My emotional stability is suspect at this point.
I have none, honestly. And I'd be looking at the stock market every year.
What little hair I have today would be pulled out by then.
Well, I'd be saying, wait a minute, the markets were down 8% this year. This is year one. Oh my gosh. We got to cancel our vacation plans. I can't do it.
Yeah. Can't go see the grandkids.
No.
Can't afford to.
No traveling.
Can't help them with school.
Because I don't know what next year's going to bring. Maybe next year will be even worse.
Now, to be fair, we did break the 4% rule. Now, we kind of only broke the 4% rule a little bit because we didn't even do any inflation. But if you want to play the 4% rule, if all we want to take out is $40,000, the numbers are a little better. So you end up, if in the good sequence, you end up with almost $1.2 million instead of just $1 million. And in the bad sequence, you end up with a little over 614.
Yeah, but you're taking less.
But you still only have 614.
So when you see these numbers, Professor Plum, now you compare that. I had after 15 years, when the sequence, the first 5 years were really good, my $1 million turned into basically $1 million, was still $1 million,
right,
give or take, after 15 years. With the bad sequence of returns, my $1 million wasn't even close to that. I was down to $320,000 roughly.
Ending value.
Ending value. Now, go back to our bucket strategy that you did last week on last week's show. Your $450,000 over 15 years at an 8% average, and you can use an average in this case because you're not taking any money.
Because I only put money that I could leave alone for 15 years.
Right, so you can work with the average.
I didn't put the whole $1 million into the average growth rate. I put the $450,000, 45% of the money into something that I could, going back to last week's podcast, 45% of the money into the stock market where I could understand. I have time for it to go up and down, and I'm not going to freak out about it. Well, leave it alone.
And regardless of what the sequence was, you still wound up doing an average 8%, which was slightly lower than probably you could get over 15 years. But let's just say 8%. You wound up with $1.4 million just doing the math. Now, and by the way, you didn't have to worry about whether your sequence was good when you retired the first few years or the sequence was bad. You could look at the stock market and say, gosh, it's down 12% this year. That's interesting. I think I'll go have a sandwich.
Yeah.
All right. Or you could say, hey, the markets were really good this year.
Maybe I'll take a little off the top.
Maybe I'll just, let's put a little in our pocket and value average. Okay, so right away, you begin to see why we talk about buckets and we talk about when you do it the other way, why it is potentially very dangerous.
Now, I was just playing with some other numbers because numbers are kind of what I am. In the original good sequence area where we were taking 50,000 a year out, if I wanted to get similar results from that ending value, I just need to earn about 4 or 5% on my bucket number 3, doing it a bucket's way. I don't have to be as aggressive.
Well, again, because you're taking money out of the, what we'll call it, the non-volatile side.
Right. I am not subjecting myself to negativity. I'm not subjecting myself to risk, the permanent loss of money, the permanent loss of value. Risk is the permanent loss of value. Volatility is a temporary downturn in value.
Well, and let me say this. Good point, Professor Plum. And let me say this. I mentioned that after 15 years on the buckets portfolio, this hypothetical example we did, you had $1.4 million. On the good sequence of returns using the systematic withdrawal, you had $1 million. So you actually wound up with more money after 15 years doing it the bucketized way. But the point isn't even that you wound up with more money after 15 years. The point, I believe, Professor Plum, is that you didn't have to worry.
Right. The emotional issue that having an appropriate strategy gives you takes a lot of stress. There is value to no stress. There's value to no drama.
Well, you know why? Because you're not going to panic and sell out. I mean, who wouldn't? You're down 4 years in a row.
And even if you don't sell out, you're pulling your hair out.
Well, you are. And you say, I can't handle this.
Right. Or you're changing your lifestyle.
I'm going to move. I can't afford to live here anymore.
I'm not going to do the things that I had dreamt about in retirement all my life because I had the misfortune of mistiming my retirement, and I unfortunately retired when the market went down. I retired in 2006.
Yeah. Oh.
I retired in 1999. 3 really bad years.
We had bad years, yeah.
And even when you look at, and I don't have the graph in front of me, I'm sorry, but I have a graph that shows me every year, the annual returns for the year, but also the worst point of the year during that year. And in almost every year, there's a point in that year where it's negative for that year. Now, even years that have a 20% return, at some point in that year, it might have been down 3 or 4 or 5%.
Yeah.
And if you're taking money out on a monthly basis, you're finding that point. Now, it's not when it's only down 1 or 2%, but it's up positive for the year. It's only slightly detrimental. It's not death.
You're right, and I've seen now. We had the big crash in '87. You remember in the market,
but the '87 was a positive year.
But exactly my point, it's what you were saying was there was a down point in October of 1987 where we were down. I mean, it was bad.
It was like 20% in one day.
Day, but we wound up for the year. But even on up years, as you just said, where we've had good years, up 20%, up 25%, something like that. There are always points, 1 or 2 points, if not more, where the markets overall were down.
not a happy day.
Or even a happy month in some cases.
Most of the time we are in retirement taking distributions from the portfolio on a monthly basis. So we're probably going to find those months. And if we have prolonged series of months, we're finding a lot of months that are down. So like I said before, if you can find an investment that never goes down, that always goes up for the next 15, 20, 30 years, doing that type of investment, systematic withdrawal, is going to work fine. But so far, I've never found it.
Well, there won't be one, because what happens is if there were no risk in stocks, if there were no risk in markets, everybody would be throwing their money in there, and it would by nature create itself a bubble, and it would collapse under its own weight. It just cannot happen. It is physically impossible, if I can use that word, for it to happen. Now, so this sequence of returns is probably the biggest reason why I think Professor Plum, why you like buckets, why we promote it. And
the reason is that from a math, from a science, from a physical standpoint, it works. But that's only, as I mentioned earlier, part of it, because that aspect of it allows us to help manage the emotional, the non-scientific, the non-math portion, the stuff that's much harder to control. The emotional aspect of managing your own money, managing your retirement, managing your income. Because unfortunately, we're all human, and we are both greedy and fearful, and we do things when we react. In many cases, we react the wrong way. And that's not just about money. That's about almost anything. So, but if we can find a way to not only manage the volatility that's inherent in the market, manage the returns to an expectation that's more realistic and more expected to actually occur rather than hoping for average, and then also manage our reaction, our ability to control ourselves. We take stress out of our lives, which prolongs our life, which I guess is both a good and a bad thing. I mean, maybe we do live to be 120, that we got to worry about not a 30-year time horizon, a 50-year time horizon.
Well, that's right. And the behavior, the emotional part of it is something that will never go away. I've done some research where somebody wrote 100 years ago that they said it was 130 years ago. And they said the trick of money is not the making of the money, it's the keeping of the money.
Yeah.
And I said, well, yeah, but it's because of behavior. And that will never change. Okay, let me give you just a quick thing. There's something called accumulated knowledge and cyclical knowledge. Okay, accumulated knowledge is things like medical,
it stacks on top of each other. Everything we learn keeps getting better.
Right. So the next generation has their starting point is where we left off, right? So knowledge just keeps getting better and better and better. But cyclical knowledge, which is the knowledge that you could lose your money at any time during the stock market, that people are, greedy when fearful and all that other stuff. I mean, this kind of thing will never go away. We will never reach a point where people all are acting rationally with their money because they saw 100 years ago how they weren't. That is what we call cyclical knowledge, and it will never change.
Well, I remember back in the 90s. Yes, I'm old enough to remember the 90s in the market. And people were looking at buying stocks. And if it had .com behind it, people were just throwing money at it. But the idea was they stopped looking at PE. They stopped looking at fundamentals. All the old ways of valuing a stock and projecting what its potential growth ability was going to be didn't matter anymore. It was a new paradigm. It was brand new. Everything was out the window. The old just didn't work anymore and had no place in the stock market valuations anymore. And they were just, stocks were going nutso. 95, 96, 97, 98,
until
99.
They stopped.
Right up until the point where the emperor had no clothes, had no money either. And things just fell apart overnight.
And people can't seem to...
And the old valuation ways came back into play.
They always do. What happened in 1999, what happened in 2008, and what happened in 68 and 69, all that stuff has happened many, many times before, all right? Maybe not exactly, but it's the same thing. Greed cycle, fear cycle.
We think something new is coming around.
And everything's changing, and it always goes back. And that's why it's cyclical. So I wanted to point that out because, what a bucket strategy we believe will do, will take that out of the equation. The fear, the greed, and all that kind of stuff goes out the window if you follow that kind of a strategy, as opposed to the systematic withdrawal method.
Right. I've mentioned the story about a gentleman I knew in Seattle. Prior to being bucketized, when he was still working and he still had time to work on things, he would wake up in the morning, and this is what he told me. He would wake up in the morning and he would watch the news programs, the business news programs, and his mood for the day, in many respects, was dictated by how the early returns were going in the market, and more importantly, how the early returns on his portfolio were going.
Yeah.
And then, as he got close to retirement, he listened to us, and we ended up bucketizing. And he came in a couple years after being bucketized, a couple years after retirement. And he's like, you know what? I still wake up. I still watch the news in the morning, but I really don't care. It doesn't affect me. It doesn't bother me. I don't have the same reaction to negative market news.
Well,
and he goes, I'm still happy with positive market news, but the negative market news doesn't have an impact on me. It's so refreshing.
It goes back again to addressing the human behavior issues. It goes back again to addressing fears. Why you do this is to address the fear that people will not have money available to them when they need it, which is equivalent to running out of money before you run out of time. The idea is to get that fear off the table and not have to consider it. Because think about it. If you had no chance of ever running out of money, then what do you care what happens around you?
Right, and that's when the hardest person for me to help is somebody who doesn't need anything. They come in and they say, how should I invest my $1 million portfolio? Well, what do you need from the portfolio? Well, I need about $10,000 a month to spend, but my pension and my Social Security and everything, it's about $12,000. So I'm actually still saving, even though I'm retired.
I don't need anything.
I don't need anything from the portfolio. Yeah. Mostly, it's just going to go to the kids or charity or whatever down the line. Okay, that makes it more difficult because there's no clear-cut reason for investing. Now it's a matter of psyche, getting into the emotional. How do you feel about the market going up or down? Are you a bigger side of fear of missing out, or are you a bigger side of fear of losing? What drives this? And so that's the hardest person to help. I mean,
let me ask you this, Professor Plum. Why, given all this information we've done on today's program and the bucket information, talking about the bucket strategy that you do, the benefits that we see, the potential benefits that we see from that, why would anybody ever consider doing this sort of systematic withdrawal? To me, that's like getting on the airplane with an 8% chance of not making it.
Because it's really easy. Because there's no thought. You don't have to worry about it, at least not in theory.
But I'm a client. I think I am going to worry about it.
Well, I'm just saying, why would somebody use that approach? Because they don't know any other way. Yeah. Because that's what's been preached since the dawn of time. Because it's easy. Because from an advisor standpoint, it's really easy, and especially as I mentioned earlier with computers, I can set it and forget it and be on the golf course by noon.
I've often thought that's the case.
That's very easy, and I don't have to worry about talking to my clients so much about rebalancing and what's going on. And the reality is, when we do reviews with buckets, we spend a lot of time talking about their life and what's happening in their world, what's going on, to try to get a flavor of what might be coming up that might be different for their portfolio, because we've already got the income covered.
Yeah.
But it's just but it's a matter of time.
I was reminded when you mentioned late 90s, and then it all came down to the dot-com crash of 2000, and then there were some bad years there. But I mean, for the first few months, it was really bad. I mean, this thing really tumbled.
Starting in March, late March
of 2000, it really did. It started to go down, and I'm reminded of this because at about that time, right at that time, I began hanging out here with the folks at Lucia Capital Group. Okay, back then, you were already here, but I kind of came on as a full-time person back then, and the markets, of course, are going nuts. I'm in a financial planning place. I came from the radio side, so what do I know? But I'm looking around, and
given the stock pick that you took in March, not much.
I know that. Yeah, we won't get into that. It was a mutual fund, but yes. But as I was kind of walking around the offices back then, this is 24 years ago, 25.
After the market or during the market crash,
and there's nobody calling to panic. I mean,
no, we didn't get a lot of panic calls. We didn't get any panic calls for the most part.
There really weren't any. And I went to the person in charge at the time, and I just said, well, I'm looking at the markets. I'm watching.
You're looking at your 401k going down like crazy. You're saying, I'm panicking. Why? And I don't even need the money for 30 years. Why are the people that need the money panicking?
And this is where John, he says, let me explain to you how this works. And so much like you did last week on last week's show, I began to see, and I said, oh, well, this seems like the way to go, because there were no panic. Same thing as I recall, in 2008, 2007, 2008. I mean, things were pretty bad. I mean, we were on the verge of, the country, the economic future depended on TARP, if you recall that. But again, there was no panic. So if you can manage and get rid of this problem of sequence of returns through a strategy. That's the biggie, because it also in turn manages your behavior, and it keeps you from pacing the floor at night. I mean,
I don't want the market to dictate what you can or cannot do in your retirement. I want you to be able to dictate what you want to do when you want to do it, not just because, it's a good year in the market, I can actually go see the grandkids. It's a good year in the market, we can help pay the kids' education. They're not going to make it in their second year of college this year.
Right. Yeah, we don't want that. I mentioned at the beginning of this episode the Bucket Strategy Guide. Professor Plum did, because we had the suggestion that we could tell folks to follow along if you want to do that. You can get that guide, and it will explain this to you in just a few pages. Now, the pages, it's probably a 30-page guide or so, something like that. But either way. If you just want to read the first few pages and get the idea of buckets, 22 pages? Okay. Either way.
23 with disclosures.
Okay. You can read the first few pages and get the idea, I believe.
Right. The concept is outlined in the first 5.
Right. So if you want that guide, it's free to you. Go to LuciaCap, LuciaCap.com, LuciaCap.com. You'll see a search bar in the upper right part of the page. Type in Bucket Strategy, and you can download it. You'll see it there. Download it, read it at your leisure, or leisure if you prefer, and just see how it works. If you missed last week's episode, check that out. But you can see how it works, and then read the rest of it when you get a chance to show you why. We go through some of the stuff that we just talked about on this episode And it explains in real numbers, and you can see how it works and why we believe so strongly in it, and why, Professor Plum, you've been doing it for 30 some odd years.
Exactly.
I mean,
I truly believe that when you're looking to create investment strategies, you have to understand the time horizons, and you have to control the volatility to your advantage, and not let it turn to risk.
That's why we do this. Give them a call, 800-644-1150. That's the number for the folks at Lucia Capital Group. Professor Rick Plum is the chief financial planning officer. So, I mean, to me, if he says this is the best way to do it, I tend to believe him. And I've known this guy for a long, long time. So I would trust him when he says that. 800-644-1150. Or go online, luciacap.com. I mentioned that before, luciacap.com. You'll not only find the bucket strategy guide, you'll also find a Social Security guide that's up there. I believe we have an estate planning guide and maybe a couple of others. But also videos, audio. We've got all kinds of resources for you. And check out the whole bucket strategy. I guess the entire... It runs the gamut of different resources that you can see. All right, luciacap.com. This podcast, of course, you want to subscribe to this podcast. I would highly suggest you don't miss a single episode by subscribing. Go to Apple Podcasts, Spotify, and anywhere else you can find this podcast. Listen every single week. I can almost guarantee you. I won't guarantee. I can almost guarantee you'll learn something every week. Now, let's see. We had some great minutes early on. We had some really good minutes in the middle, and we've had this, This was
a better than expected market.
It absolutely was. So maybe it's time to value average. I can't promise anything for next week, but I think next week is episode 200.
I thought we were taking some time off.
Oh, we are. Oh, right. Okay,
so you gave me some time off early. You teased me with some time off.
You're right. I apologize. As we go over I have to check the dates, but I do believe we're going to be taking a couple of weeks off. But either way, the next live episode we do will be episode 200. I don't know. It may be nothing.
Maybe we can get some other guests besides me.
I've talked about that. I talked yesterday with a couple of people who said they'd love to come on the next quote-unquote season. So we'll see. We are out of time. I appreciate you listening. Professor Plum, thank you for doing this. It's a follow-up to last week, but it's so important to understand. You can't have one without the other, and I do believe that to show what we believe is the right way to do it and why we believe we should do it this way, I think it's best to show what could happen if you don't do it correctly, and you could just run out of money. My thanks to Professor Rick Plum, certified financial planner professional and accredited wealth management advisor.
Ooh, you are so good.
I am. Back with more next week. Thanks so much for listening. I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. We'll talk to you again soon.
Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Before investing, carefully consider a mutual fund or target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.